40 years of declining interest rates. And so there's never a time where they sharply raise interest rates so much that their liabilities are yielding a higher interest rate than their existing assets. Whereas in 2022, they raised interest rates so quickly that the interest that they're paying on their bank reserves and interest rates that they're paying on reverse repos are higher than the average interest rate that they're earning on their treasuries and their mortgage-backed securities. And so the Fed now has an operating loss instead of an operating income. And so they're now basically, if they were a normal bank, they'd be on the verge of insolvency. Yeah. But because they're a central bank, they're different.
The U.S. Federal Reserve, according to Lyn Alden, is currently running at a financial loss and is just a few months away from experiencing negative tangible equity for the first time in modern times. Lyn investigates how we arrived at this point and the significance of any of this for investors and savers in this video. While Lyn Alden explains the Fed's self-destructive path and current situation, we will now enter the video. Please remember to like, subscribe, and comment below while you watch.
They're not supposed to really do their actions based on making a profit, and they're not incentivized to because they have to give all their excess profit to the Treasury. Okay. Right. So basically, the reason that they make a profit is for independence. Like I said before, if they were just an arm of the government, then they would be reliant on funding by the government, and they could be told to do all sorts of stuff right before an election, for example. But instead, by operating, almost like an independent agency, and there are central banks around the world that are publicly traded. It doesn't really mean that much, but they still technically are. They're publicly traded. The Federal Reserve's not, but some are. So you have this degree of independence because they're not on paper insolvent. They have liabilities, they have assets, they generate their own income, they cover their own expenses, and then to avoid them operating in such a way that they're a profit, they have a monopoly, so you want to control their activities to some degree, and so they have to pay their excess profits above their baseline expenses to the government, and so that's historically how the Fed has operated. The Fed's kind of different than other central banks in that it's a public-private partnership, and so it's a little bit more complex. But at the end of the day, it's just kind of this semi-autonomous entity, but that is nonetheless overseen by the government. Going back to the assets and liabilities, their main assets are treasuries and mortgage-backed securities, and their main liabilities are bank reserves and physical banknotes. And so for most of Fed history, their assets paid a higher interest rate than their liabilities. And so after covering their expenses, they earn tons of money, $100 billion, and then they give all that to the Treasury. And so in some sense, you can think of that as, the Treasury has to pay interest to the Fed because the Fed holds a lot of Treasury securities, but then all that money just goes right back to the Treasury. Basically, that almost like that portion of the debt is like zeroed out because any interest they pay on is essentially going right back to the Treasury. What makes them independent is that they are self-financing, and so they're required to give excess money to the government. Right? It's not like every year Congress has to authorize money to go to the Fed to pay salaries, for example. Like let's say NASA, the U.S. Space Agency, their operations, their employees are paid by authorizations of Congress. And if for whatever reason Congress just says you don't get money this year, well, they're out of luck. They just would have to not operate. They'd have to shut down. Whereas a central bank, because they're a self-generating entity, they're not reliant on these specific funding authorizations from Congress, and instead they're left to kind of make their own money, but then they have to give excess money to the government. So it's kind of this attempt at decentralization. Now it obviously runs into limits. During war, for example, or major crises, central bank independence kind of goes out the window to varying degrees, but during most of the time, that is basically an attempt by the institutions that are constructed in order to make it more decentralized than it would be if the central bank was just a direct arm from the government. One reason is because of the way the accounting's set up, they don't get kind of near-term consequences for having negative equity. And so the way that Federal Reserve accounting works, so right now they're operating a loss. They're no longer sending money to the Treasury because they're not making money to send it to. But then what they're essentially doing is they're eating into their equity But instead of actually market to market and saying, okay, now we're actually approaching negative equity, they give themselves an asset. It's called basically it's a deferred asset, so that in the future, if they're ever profitable again, they get to pay themselves back first. They get to dig themselves out of this hole before they would resume having to give their excess profits back to the treasury. And so it's kind of like if you had a business and it starts to go bankrupt, and you say, well, in the future there'll probably be a time when I'm not bankrupt, and so you basically borrow from the future, from my future self to pay back when that happens. That's kind of the thing that the Fed's doing, where they're approaching negative tangible equity. But unlike a normal bank, there's no consequences when they hit zero. There's no consequences immediately, at least when they go negative. And so the main difference is just that they can continue operating, and it's actually the main consequences are for the Treasury. The Treasury now has lost $100 billion income source.
Yeah.
And even in the future, when the Federal Reserve is profitable again, if they're profitable again, it would be a long time before that income source is recovered, because the Federal Reserve would be not sending remittances to the Treasury, because it would be digging itself out of its prior hole before it would ever begin sending more money to the Treasury. So basically, the Federal Reserve is able to do it because the consequences are, for the most part, not on them. They're on the Treasury, they're on the taxpayer, rather than them. Now, if it goes on long enough and kind of to a significant enough degree, you could start raising questions around central bank independence, right? Because if you're technically insolvent, that starts getting that's a different scenario, but that's a long way off. In this sort of intermediate phase, they have virtually zero consequences for this, and the consequences are instead on the Treasury. It's probably going to continue for a long time. It's not as dire. So the reason I wrote this article is because a number of weeks, months ago, I started to see basically these doom charts, especially because the St. Louis Fed charting system is kind of broken for this particular metric, and so it looks really bad. And so there are a lot of people sharing that on Twitter. So I actually was inspired to make an article to say, okay, what is behind this crazy chart that I see being shared around? So the short version is there's nothing going to explode because of this. There's no near term or even intermediate term wall that they run into for doing this. Instead, the main couple consequences. One consequence is that budget deficits are going to be bigger now, because that $100 billion income source just completely vanished and is not coming back anytime soon, most likely. So that's equivalent to 4 NASA's worth of expenditure, right? So these days, $100 billion seems like nothing to people, but NASA, for example, is like 25 billion. So the U.S. government lost an income source. That's one tangible consequence from this. On the other side of that, the commercial banking system is basically getting paid pretty well because of this, because all that negative equity is basically draining out of the Fed and going into the commercial banking system. So they're actually making out pretty well. Those liabilities, those higher liabilities from the Fed, those higher yielding liabilities, I should say, that's paying out to banks. So banks are basically getting paid to do nothing. So they don't mind the situation. And the longer term potential consequence is you'll get someone like Senator Warren or others either complain that the Federal Reserve is paying banks too much, or you'll get people starting to say hey, why do you have this much negative tangible equity? Doesn't that threaten your central bank independence? And so some of the long-term consequences can build up by starting to politicize even more so what some of the Fed actions already are.
What do you think of Lyn Alden's macro perspectives on the Fed scenario? Comment below with your thoughts and let us know. Moreover, be sure to subscribe, hit the like button, and enable post alerts. Many thanks for tuning in.